Barry, you're smiling. Does that mean you're buying today?
Actually, I have been buying today. This is nothing to smile about, obviously, and the path of destruction is definitely impacting a lot of different areas, from airlines to hotels and the like. But picking up perhaps some international holdings, buying some gold, that's what I'm looking at today. Nothing too exciting in that sense, but there are other opportunities perhaps in areas like biotech, like an Amgen, or you could even look at other folks like Johnson & Johnson. And it's a strange thing, but there are pockets that do offer some opportunities in this. But I will have to put the whole picture together. We're probably in a period of a little bit of a pullback because we've just ran so far so fast, and the market just needs to get its wind back again.
All right. So, Bill, let's turn to you. It's pretty obvious that if a country is fundamentally shutting down its travel and transportation networks, as China seems to have done, and cities like Shanghai are basically saying we're going to be closed for business for the next 2.5, 3 weeks until February 9th at the earliest, that is going to shave economic output in that very important country, and that could have reverberations not just in Southeast Asia and the neighborhood, but around the world. How do you figure this into your investment strategy?
Yeah, so I think one thing to think about is we do have a little bit of an example of this in terms of SARS and how it showed up there. Same situation, well, not same, of course. Nothing's ever exactly the same. Similar in the sense of we really saw, particularly early on, the real hit to travel, services, et cetera. So again, things we're seeing like right now, we know Macau visitations are down 60% year over year. So we know those are going to show up. I think the thing to take a step back on is two things. One is typically this, at least historically, it snapped back very quickly once the danger, or at least a big part of the danger, is passed. We obviously don't know how long that'll be, but just know typically it snaps back quickly. The other side is when you think about, let's focus on the U.S. here, we don't have a ton of direct exposure to, let's say, outright growth in China, in the sense that as long as our consumer, which is the biggest part of our economy, stays active, let's put it that way, our economy can really run it on its, I'll say on its own. Again, on the margin, it'll be a negative because, again, it's more of a headwind rather than a tailwind. It's probably more of Europe and other places that maybe have a little bit more, I'll argue, direct exposure and a little more, but I expect it to pass as well.
You know, Bill, you mentioned the comparison to SARS, and I'm seeing a lot of that in these analyst notes, but China has changed a lot since 2003 when the SARS outbreak happened. And you take a look at casinos, which is a space that I know pretty well. And back then, there were no American-style resorts in Macau. There was only one big resort company there, and it wasn't publicly held. And then extrapolate that out to the Chinese consumers in general, to the amount that they travel now. Do you think, are you comfortable relying on that comparison to SARS when you're getting ready to jump into the market and figure out when to make the investments? I agree that some of the scale has changed, but one thing hasn't changed, which is the U.S. is still relatively self-contained in the sense of we are not likely to go into a recession based on something that happens in China. Obviously, you can spin a worst case scenario, but in the end, I don't think that's the case. Now, that being said, you're right in the sense that you probably see some impact on first quarter earnings for, say, the U.S. gaming companies that have some exposure there. Again, I think, that's going to show up in the stocks. Would you jump into the casinos now?
I don't know that I do it yet. I'm not I know we haven't done it in-house yet. I can say. Certainly, we're looking for opportunities, and we've made a few changes here in terms of some things that have gotten shaken out and, looking for some opportunities. I think for individuals, I'd say we got so optimistic, I say as a whole, market-wise, there was so much optimism. I suspect we may have a little more pain to go here, but we remain, net positive on things.
Barry, a lot of people have been predicting or thinking that a correction, a 10% pullback from the peak, is in the cards for early this year. Is this that, or is this likely to be more transitory than that and not a correction?
Yeah, I don't know if we get to 10.
This is for Barry, please.
Oh, I'm sorry.
I beg your pardon. Barry? I mean, it's
well,
Barry?
as we look at it, it's a situation where the market is ripe for a correction. There's, on the technical side, up 15% in just a few months, and you have way too much enthusiasm around the market, and so it is primed. Even as we go through the earnings season, and what we're seeing is a real bifurcation. If you come out with bad earnings, you get slammed. You come out with good earnings, you get rewarded, as it were. So we see that as likely to continue. But I think there's a shift going on within the overall market, more towards some of the more value and a little more defensive side of things. And we could see this kind of bumble along, let me put it that way, instead of a big collapse.
Okay.
But this is transitory, and we think that the big things like the good economy, the Fed helping out, and the momentum will keep the market going further later in the year.